Management's own filing states aggregate leverage is at 39.0%, while net property income is down 4.9%. This spike puts your SRS and dividend income at direct risk as the safety margin for interest payments continues to thin. This forensic audit will expose the structural debt wall management carefully glossed over. I have been watching this one for a while, and the number that finally made me sit up was that gearing figure. In this deep dive analysis of Digital Core REIT, I will share my insights with you on their Q1 performance. We are looking at an uncomfortable set of numbers right out of the gate. The headline figure that should immediately catch your attention is the aggregate leverage, sitting at 39.0%. This is well above the forensic ceiling for a sanctuary asset in a high-rate environment. At the same time, we see that net property income fell 4.9%. When debt goes up and the actual income from the properties goes down, your SRS and dividend income are under severe pressure. Management's deck glossed over the structural debt wall, but we are going to break it down. We need to see if this vehicle can actually survive the next rate hike without a severe distribution cut. Management opened their update with the phrase core sustainable growth, but we really have to ask where that growth is. Looking at the actual money generated from the assets, the net property income fell from $22.4 million to $21.3 million. That is a 4.9% drop in actual asset income. Meanwhile, property expenses jumped 4.6% to $22.8 million. They are running a more expensive operation while generating less income. For our heartland investors, this is exactly like a stall owner telling you business is great, while his daily takings are quietly falling. The narrative simply does not match the operational reality. Now let us look at the operational picture. The surface numbers look solid but hide significant risk. Occupancy is high at 97.1%. The weighted average lease expiry is 4.4 years. However, the portfolio is dangerously concentrated. Northern Virginia and Silicon Valley make up 50% of the entire portfolio. More concerning, one single Fortune 50 software company accounts for 30.5% of their total top tenant rent. This single tenant at 30.5% violates my 25% concentration rule. If that one tenant decides to exit, the entire distribution for your portfolio is completely at risk. This is a hidden fragility. The balance sheet is where the red flags are waving the hardest. As we noted, aggregate leverage is at 39.0%. This is up from 37.1% in December 2025, meaning it is moving in the wrong direction. For context, Keppel DC REIT maintains a gearing of 35.1%, which passes my safety threshold. Digital Core REIT does not. If we run a negative 10% valuation scenario, leverage spikes to roughly 43%, triggering a severe rights issue risk. For a CPF OA investor, a rights issue forces you to top up capital just to keep your original dividends. It becomes a capital trap. The next massive breach is the interest coverage ratio. It has dropped to 3.3 times, down from 3.4 times. That single point drop sounds small. It is not. This is well below my 4.0 times minimum standard for a secure asset. Again, looking at Keppel DC REIT, their ICR is 7.2 times, making them nearly twice as safe. If interest rates rise another 10%, this ICR could easily fall toward 3.0 times. This leaves absolutely zero buffer for unexpected maintenance costs. A 60-year-old retiree relying on this for SRS income faces a direct cut to their distribution. There is no fortress balance sheet here when the interest safety margin is this thin. Let us look at what management is not telling you. Management spent zero time on the legislative chaos in Virginia. The Virginia General Assembly adjourned in March without resolving the fate of a $1.6 billion tax exemption that expires in 2035. With 17% portfolio exposure in Northern Virginia, this is not a footnote. It is a fundamental threat to the yield. Management preferred to highlight a 44% rental reversion instead of addressing a potential 20% cost hike. My forensic punchline for you is this: management's silence on this massive legislative risk is the loudest data point in the entire report. We have a real story of two numbers when we compare the net asset value to the current market price. The NAV per unit is $0.79. That is exactly what you would get if all the data centers were sold and all the debt was paid off today. However, the current unit price is sitting at 0.52 US dollars. This is a meaningful discount to the book value. The market is not stupid. The market is pricing in the exact risk of that elevated 39% leverage we just discussed. This heavy discount is the direct consequence of a balance sheet that makes the market extremely nervous. So how is management handling this discount? Through buybacks, which look more like a sugar hit than a real strategy. In the first quarter, they bought back 7.1 million units at an average of 0.486 US dollars, resulting in a tiny 0.3% DPU accretion. This cost 3.4 million US dollars. That capital could have and should have been used to reduce the 39.0% leverage instead. This is exactly like buying a brand new television to feel good while your HDB mortgage is in arrears. It provides a short-term sugar hit, but it leaves the broken financial foundation completely unfixed. Which brings us to the forensic gap between price and value. The investing pro fair value is 0.58 US dollars, which shows an 11% upside with medium uncertainty, but the current price is 0.52 US dollars, and that discount purely reflects the debt risk. The cost of debt is 3.5%. Until management can structurally lower that cost of debt, this discount will persist. Price is simply not the same thing as value. You are only buying the discount at 0.52 US dollars because you are actively accepting the severe debt risk that comes with it. Let us talk about the forensic yield hurdle. We audit for the storm, not just the sunny day. My risk-free floor sits at a 3.2% baseline. I demand a risk premium of 150 basis points for REITs. That creates a minimum yield hurdle of 4.7%. Now, Digital Core REIT currently offers a 6.9% yield, which clears the 4.7% hurdle we established. But do not be fooled by this surface-level clearance. That premium exists only because the market is forcing you to accept 39.0% aggregate leverage. Looking at the income sustainability picture, the key metrics fail to inspire confidence. Net property income is down 4.9% year over year, which is a clear fail. Distributable income is completely flat at 11.7 million US dollars, earning only a marginal pass. While occupancy holds steady at 97.1% and rental reversions are up 44%, these top-line wins are not translating to the bottom line. The core engine of your dividend, the actual income generated after expenses, is shrinking. That makes the income fundamentally unsustainable in a prolonged high-rate environment. The debt health picture is flashing serious alerts. As we established, aggregate leverage sits at 39.0% against a strict threshold of 35%. This is a definitive fail. The interest coverage ratio is 3.3 times against a minimum threshold of 4.0 times. Another definitive fail. While fixed-rate debt is stable at 80% and the average debt maturity is a manageable 3.5 years, the core gearing and coverage metrics are broken. The 6.9% yield might clear our hurdle, but that premium is purely the cost of accepting the massive leverage risk. Management is heavily pushing their AI and digital economy narrative. They project that AI inference will overtake training by 2027, serving as their core growth thesis. But they are hitting a massive power wall. In Silicon Valley, there is a grid bottleneck with over 500 megawatts of demand, straining a system that will not see upgrades until 2028. This is like a renovated hawker stall where the town council simply cannot provide the electricity until 2028. The debt still runs, the interest still compounds, but the expansion is entirely frozen by physics. Running through our scenario analysis, the base case relies on the Linton Hall lease-up by December 2026, which might bring a 5% NPI impact and a stable DPU. The bear case is brutal. If the Virginia tax repeal hits, we are looking at a negative 10% NPI impact and a massive 15% DPU cut. Management had previously pledged a fortress balance sheet. At 39.0% leverage, that guidance has completely failed. Management prioritized unit buybacks over the debt reduction this balance sheet actually needed. Management did earn some credibility by successfully recasting their debt to 2029, avoiding an immediate debt wall. However, deciding to conduct buybacks while the interest coverage ratio is sitting strictly below 4.0 times is a massive forensic yellow flag. It shows they are prioritizing unit price support over building a genuine sanctuary asset. My forensic punchline is this: you are witnessing a high wire act where the safety net is being woven from the exact same rope that is pulling the units. When you are evaluating a high wire act with this level of leverage, you really should not be reading these reports alone. Iggy's elite investors get zero-day access to these full forensic breakdowns before the market even opens, allowing us to cross-check the next setup together in real time. With Iggy's elite investors, you are getting those crucial zero-day breakdowns, ensuring you have the full forensic picture before the market even opens. You also get access to our complete institutional-grade cheat sheets and the proprietary Red Zone watch list. All of this access costs just 9 Singapore dollars a month. That is literally less than a kopi and kaya toast set at Raffles Place. It is time to stop being the exit liquidity for institutional players and start being the leading analyst of your own portfolio. So where does this leave us forensically? This REIT's portfolio role is an income generator and data center growth specialist. For suitability, it passes for the accumulation phase, but it is highly conditional for transition and an absolute fail if you are in the drawdown phase. The key flags are glaring: an ICR alert at 3.3 times and a gearing alert at 39.0%. While the 2027 debt wall thesis was overridden and recast to 2029, the status remains intensely active. The final verdict comes down to timing and physics. The Linton Hall refurbishment will add 13% capacity and a projected 35% net rent increase, but not until December 2026. Until then, you are staring at flat distributable income and elevated debt costs. The unit price of $0.52 sits below the fair value of $0.58, but with a 3.3 times ICR, this is absolutely not a sanctuary asset for your final retirement years. The real ceiling is the Silicon Valley power grid, because growth requires actual electricity, not just AI demand. Are you prepared to hold through the severe volatility of 39% aggregate leverage while waiting for a 2027 AI payoff? The core reality here is that you are buying into a severe power grid bottleneck while carrying a highly leveraged balance sheet. Management has prioritized short-term unit price support over structural debt reduction, leaving the dividend heavily exposed. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. The red flags were always there. This analysis is under a 7-day embargo, but Iggy's elite investors saw the warning signs early. Join the community through the link in the description to protect your portfolio before the market reacts. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.